All right, well, stock started this expiration cycle the same way it ended the last expiration cycle. Well, it's a little bit of a down day. The question, of course, is, how is NVIDIA going to, how's the market going to respond to NVIDIA's earnings? There's a huge premium built into that stock. It's one of the bigger stocks, of course, now, especially since it's up so much. We'll take a look at its chart here today, how much it's been up over really the last 70 some odd days since we hit that low point last Halloween. Big return to the upside. So we'll take a look at how the market is poised going into this week. Really important week. Not only from that particular earnings standpoint, but also from a technical standpoint. We'll talk about why there's a seasonality function here that we need to keep in mind. There's some patterns, some patterns of weakness developing. How strong are those weakness? Are they just enough weakness for us to bounce? Are they strong enough for us to reverse? So that's kind of what we're going to talk about today, and taking a look at what's driving the price action today. We kind of had an unexpected move based off of the intermarket relationships that have been driving this. So we'll take a look at that. Sector rotation, there is a clear rotation going on. And then our trade idea is kind of taking advantage of that rotation. And we'll talk about that to wrap us up. So let's go ahead and get started. Today is Tuesday, February the 20th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where I take a look at all the trades we've done in prior videos to see whether we should stay in them. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this heart, this thumbs up icon, excuse me. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Our goal, of course, is always 100 likes on the X, formerly Twitter. Thank you to those who like these day in and day out. It goes a long way for us. That's why we always ask. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator. You can see a second straight down day, which is not very common here lately. We've had a couple of these, and actually both times that we've had this 2-day decline, it's brought the near-term line at least below the midpoint of the chart, if not into the bearish territory. So that 2-day streak there, 2-day streak here brought it down. This is a 1-day move that brought it down there. But you get the idea, right? That's, here was a 4-day streak that brought it all the way to extreme lows before bouncing back up to extreme highs on that momentum line. Got obviously something could very well happen again if NVIDIA really rebounds and takes off after its earnings announcement, and the market takes off with it. Regardless, the near-term line did peak with a bearish peak. It did not get in the reversal zone. Did barely, like 80.02, but that's about it. And then the near-term line again down, not quite in the bearish territory. It actually was in bearish territory when we were at the lows of the day. You can see the momentum line, which was at pretty oversold levels on Friday, rebounding, but still in bearish territory itself for a second straight day. So a 2-day decline, right? The intermediate line, like I said, falling below market sentiment, but still in the upper reversal zone. So weakness, but not strongly bearish yet, right? Not strongly bearish yet there. Looking at the NASDAQ 100, which has was pretty weak today because of a lot of these Magnificent Seven stocks, including NVIDIA. Again, off of the lows of the day because of a nice little late intraday rally here. But you can also see too that its near-term line did get well into the reversal zone. Its intermediate line is also below market sentiment, and actually almost below the 80th percentile. The momentum line, like the S&P, is bouncing, but still in bearish territory. It's a little bit deeper and more bearish of a peak on the near-term line than what we saw in the S&P. The Dow Jones Industrial Average, you can see its intermediate line actually has fallen below the 80th percentile, obviously is below market sentiment as well. Near-term line is not as bearish as even the S&P, is actually still in the upper half. But again, light pink shading, we don't have that on any of the other two. That's because the intermediate line fell below. And then the momentum line did not drop too far on Friday, and actually now is down. So now you have an oversold momentum line, but just barely there. And then finally, the Russell 2000, its intermediate line is also back below market sentiment, but both lines are actually below the 80th percentile and falling. So this would be a really bearish intermediate peak if that ends up being the case. Because again, we were in bearish territory, so we did have a slight intermediate pullback here. We did bounce back into bullish territory, but we did not get into the reversal zone as of right now. So, again, for some context and just how uncommon that is, to go from bearish territory to bullish without getting into the reversal zone. Again, this is the last, 10 years? Last 10 years here, to go from bearish territory to the reversal zone happened right here. And again, we actually were pretty oversold there, but we got into bearish territory, did not get into the upper reversal zone. That ended up being a lower peak. Again, this one did not get into bearish territory there. You can see right here, we got into from bearish levels up to bullish levels, did not get into bearish territory. You saw the intermediate decline that followed off of that. It was actually more of an intermediate decline than what we saw previously. And then right here, again, we went pre-COVID from bearish levels up to bullish, barely got above market sentiment, came back below without getting above the 80th percentile. Very similar to what we're seeing right now. And then you can see, of course, COVID, right? I mean, that's a pretty distinct pattern. So again, you can see this is not a good sign, especially, again, like I said, getting back below with a bearish near-term peak. And it's actually a divergent peak because you have higher highs with the lower highs. And then, of course, the oversold momentum line for the second straight day. Pretty decent gap coming off of that Harami pattern that we saw on Friday. So pretty significant drops there. Taking a look at some of the other asset classes like the dollar, one of the more important asset classes driving the market here lately. It's been relatively bullish. The last 3 or 4 days have been pretty bearish. The intermediate line, market sentiment is still rising in bearish territory, but your intermediate line is falling toward the 80th percentile. Still well above market sentiment, so not a threat yet. And your short-term sentiment is pretty bearish, so you would expect that it's going to bounce. It's just a matter of how much. The 10-year yield, also an important factor in risk appetite here lately. Unlike the dollar, the near-term line did not fall down, so we didn't get as much of because we had a big bounce on Friday. The momentum line's back in bearish territory, but not oversold. The near-term line's still in bullish territory, so we've been on one big near-term run for a while now. Getting up to new highs, so we'll see how much longer that lasts. And of course, crude oil being the third asset class that's been really kind of dominating risk appetite and driving the markets. You can see its intermediate line also in the upper reversal zone with a little bit of a divergent near-term peak on a near-term rally that might be running out of gas. But again, an oversold momentum line. This is a bullish intermediate confirmation signal you would expect. That will bounce off of this and work our way up to the upside here. If we take a look at some of the other oscillators right now, including the weekly chart, so here we are. So after getting weeks after week after week of higher highs and higher closes, this is the first week that we're really susceptible to a lower high and a lower close, right? And in other words, a transition candle where we transition from one trend to another. Now we can transition from one trend and stay on the trend, right? But again, it's not common to do it once, and definitely would not be common to do it twice along the same trend. So any kind of transition candle here, the odds of so here we had a trend transition and then a continuation of a trend, and then the second transition turned us down. This would be the second transition from an even higher PPO than what we saw there, and a divergence, right, with progressively lower highs on the size of the candle Hakinyashi body as we get higher and higher to the upside. So definitely a sign of weakness in that regard. Taking a look at the 3 green arrow charts, we don't have 3 green arrows in any of the indexes anymore. The Russell gave us the red arrow on Friday on the stochastics. It still only has the 1 red arrow. All the other indexes have 2 red arrows with a pretty decently bearish MACD on the Nasdaq, but still don't have that 3rd red arrow yet. That would really start to make us wonder about the strength of the current intermediate trend that we've been on. We've been above the 30-day moving average this entire time, so we'll see how much longer we last. We're still above the 17-day, even though the MACD is below its moving average. The stochastic's also below its moving average. So we're at best, we're in convergence mode right now, where we're still higher. We're still above the averages, especially the 17-day, because that's the second number in this MACD. So we're still above that 17-day, but the MACD is not, confirming that. So that's convergence. That can lead. Over here, it led to. It's kind of like the, what we talked about with the transition candles. It can lead to a turnover to the downside, or it can lead to a new impulse move without the consolidation. So it's the same thing. We can get this convergence can lead us to a consolidation, but we never did get one here. We just continued higher, and we'll see if that ends up being the case here. The Qs, remember, a little bit more bearish, flirting more with that 17-day moving average. IWM has been a little bit more bullish lately and is still above its average. The MACD, in fact, still above its moving average too, even as the stochastics crosses below its line. Let's take a look at the DMIs. And here's the interesting fact. This is the only time in the past 10 years that the DMI negative indicator has been above 25, and the positive has also been above 25. Not only above 25, but the positive is still above 30. It's very, very uncommon for the you can be above. They can both be above 20, but it's rare for them to both be above 25 at the same time. In this case, sometimes you might get that, but because they're like crossing down to the downside, like here, and it might only last for a day or two. It's very uncommon to get it when we're rallying. Again, goes to show just how strong this bullish indicator is, and how parabolic we've been. Again, even on the weekly chart, you can see this ADX is moving up really strongly here as your positive indicator almost hit 40, which is, again, very rare. The only time that the weekly indicator has been this high was back in 2018 when it went well above 50. And the ADX itself also climbed up that far. So that's not a very common move. So outside of that, this is a pretty high level, especially too with the negative indicator as low as it is. So you're going to get a pretty decently high ADX within the next week or two. But it goes to show just how parabolic we've been. And you can see that as well on the Ichimoku cloud, right? The strength of the trend is still at very high levels. It's not above 17 anymore, but it's still up there. You can see we're not above 95 on that noise balance down there, but you're close. You are flirting with the green line, which is the first stage of weakness when you're so parabolic. But it goes to show just how strong of a move we've been in. IWM, as you can see, has not been. And, since we peaked and broke that upward trend, we've been sideways. We've been up and down, but pretty much sideways. Currently above the cloud, currently with a positive rate of change, but no trend at all going on here. Looking at the RSI and the CCI, you can see breaking back below 60. So we're not bearish, and we're not below 50 yet, but we're not bullish anymore on the RSI. And you can see the same thing on the CCI. We're not below 0 yet, and definitely not below minus 100, or even really need to get below at least minus 150 if we're going to have any signs that things are changing. So I can edit this and move this to today, and pretty much can do the same thing with this as well. Move that to today. So both those lines are still green, which is positive when they're both green like this. But like I said, the first stage of weakness is breaking below the minus 150 at least, and even that's not a guarantee. As you can see, we had a few instances over here where we went below minus 50 and never really turned bearish yet on the CCI, though it did signal the end. Like the RSI eventually got below 50 and confirmed it with dropping below 40 on that move below 150. We didn't do that quite over here. As you can see, we never did get below 40 on these declines below 50 in the early stages of coming off of the banking crisis from last year. So those are the kind of things you watch for on this particular chart. Looking at the Bollinger Bands and the Keltner channels, we are not in the upper bandwidth anymore. We've been in the upper band for quite a while. But remember how we kind of started this without being in the band at all. Then we broke out there. Then we broke out again here on the second leg higher. And now we're outside the upper quartile. We're still in the upper half of a declining bandwidth that is moving its way back towards the Keltner channel. So we'll see if we get red dots again. So we got red dots there, but it didn't turn into a trend change like you would expect. It turned into a new impulse move. And Again, we've seen that before, and it only generally happens once, and then we go bearish, right? Because like we should have been more bearish here according to the momentum indicator, and we didn't. We had one last leg higher, and you can see what that turned into. So this kind of move we're susceptible to that kind of move right now because we didn't get it here when we should have. We had one more leg higher, similar to this last leg higher, that ultimately peaked and went into consolidation mode. Let's take a look at the 4-week range. So again, we filled in this gap. We have a new gap today to fill in. We opened below yesterday's Friday's low point and stayed below it the whole time. So we had a lower high and a lower low. All the entire range today below Friday's low. Still right smack dab in the middle of last week's range. So again, the next stage of weakness for if we get it would be to get below last week's low point. So we'll kind of keep our eyes on that. Obviously the range and the volume were not very big, and we were below average, just slightly, but below average on the range. We are slightly below average on the volume. Both those averages are very, very low, though not as low on the ATR as it used to be. Right below the 90th percent mark, 0.9% mark, and then also on the volume falling down there as well, as you can see. So not quite as low as what we've seen, though you expect that we'll get a move higher at some point in time and we'll see if that ends up breaking the average and really starting to trend up to the upside. And really, the best way to see that's on the money flow, because that's more of a normalized volume. You can see the money flow. The money flow index is still in bullish territory. It starts to get bearish when it drops below 50, and like I said, like the RSI, really solidifies and confirms the change in direction when it gets below 40, kind of like it did over here. So that's something to keep an eye out for as we are now below 60. We'll see if that turns into something more. Volatility is also an important consideration to keep an eye on. The VIX was up today, but it's up almost every Monday, so it's not a surprise. It is up to the top of the neutral range relative to the VIX 3M, so that 95% mark still holding as a resistance. The VVIX also went up today, up to 86%. So it looks like our VIX is starting to, like we've been talking about this for a while now, but we're entering a seasonally bullish time for volatility in the VIX, and we are above the 200-day moving average on the VIX, which is sitting here right around, where is it, 1503 now, so quite slightly above 15. So that's a significant change in sentiment. For like we're on a bullish pattern right now for volatility, and we're according to the seasonal charts that we would expect that that's going to be the case going forward, as we generally have a rise in volatility pretty much all the way towards the middle of March here. March 15th, 14th area is when we ultimately peak. So this is the standard. Like, it's normal to be bullish on volatility this time of year, and we generally move towards the highest of the year before retesting those highs later in the fall. But we generally set the highs of the year before falling down to negative levels and then setting the lows of the year post July 4th. So this is the time of year, and volatility is following its normal pattern right now. All right, now let's take a look at what's driving the price action today. You can see, again, U.S. equities over the last 3 months continue to be the dominant force across all assets out there. Today, not necessarily the case. They ended up being the weakest force. So IWM being down 1.4%, Qs being down 0.75%. International stocks were up a quarter to 0.5% today, thanks to a weaker dollar, weaker commodities, and weaker yield. So those three things typically actually lift stock prices higher. As you can see, not the case today, as they were actually pretty far down. They underperformed equity or the dollar and commodities, including real estate as well. So pretty rough day for all the major assets. Again, it mainly has to do with the main three things: the dollar, the yields. But you can see, like, the weakness in the dollar, again, did not break that 17-day, still above the 200-day moving average. Hasn't broken the 17-day, even though the MACD and stochastics are down there. The yield still above its 8-day moving average and 200-day moving average as well. And then commodities are still pretty bearish down there, really converging on these lows at the very bottom. Remember, the biggest component of that is crude oil, which actually is near its 200-day moving average and also still above its 17 days. So some short-term weakness in those main three asset classes that are driving risk appetite right now, but short-term, nothing trend changing in any of those indicators at all. If you take a look in the U.S. equity markets, again, part of the main reason why we're seeing weakness is you're down pretty much across the board. The only one I've got all 12, I got all 7 of the Mag 7 stocks here, but I've also gone outside to the top 12 stocks, the biggest 12 stocks that are inside XLC, XLK, and XLY. So including Adobe, Broadcom, Adobe, AMD, and Cisco in here, along with Netflix to go with XLC. XLY still really being just Amazon and Tesla. But again, everything down, all except for Google. It was really the only one that was up today. You can see some of these are down, like Cisco and Adobe have dark pink shading and a red line. Apple has had dark pink shading and a red line and now has a yellow line, but still pretty bearish there. Google's had a bull tag and has continued down to 42 now in this intermediate line. You've had dark green shading and green lines on Nvidia and Amazon, Meta, and Broadcom and Netflix, but they're all kind of pulling back towards that moving average right now. Tesla's still in a downtrend. Adobe really broke down hard, and AMD is getting a bull tag today. So, signs of weakness all across the board, across these really important stocks, and you see that as well when you look at the sector grid, like the 12 grid for all the different sectors. XLK, XLY, XLC up here at the top. Again, you can see the light pink shading for technology and discretionary. Communication services still has your dark green shading and green line. So does financials, industrials, healthcare, staples, materials. Energy technically does too, with some weakness in utilities and real estate. But you can see when you look at this, there is a pretty decent rotation right now in these sectors. So right now you have technology and communication services in the weakening quadrant. Let me just update this to make sure it's up to date with current prices. So technology and communication services, are in the weakening quadrant. Staples actually still in the lagging quadrant. But everything else, utilities and real estate have come out, and healthcare for that matter as well, in the last 2 weeks have come out of the lagging quadrant. Financials has barely got out of it today. Energy was briefly in it and then came out of it, and then discretionary was in it 2 weeks ago and then now is out of it. So you've had a big change in a lot of these sectors. Pretty much every sector that's in the improving category was in the lagging category within the last 2 weeks, and now they're improving. And industrials is making the first move here into industrials is making that first move into this. Let me go to a daily chart on this. Into the leading quadrant, right? So if I were to go to a 1-year chart, to keep it on the daily. So we've been lagging behind, but it's fine. The ratio of XLI, the relative strength chart for XLI relative to SPY is now above its 50-day average. You can see the renewed, the relative strength being above 100, momentum being above 100. That's why it's in the leading quadrant, and you're well above the 8-day moving average there. So it's a pretty good, we're seeing a significant change as the Qs are now trading below that 30-day moving average for a third straight day relative to IWM, to the point where the MACD has gone negative below its moving average. The long-term MACD has gone negative. The histogram, has gone negative as the MACD has crossed below its moving average, albeit at pretty high levels. And you can see a bearish CCI, a bearish, below 50 at least on the RSI, and then you can see relatively bearish DMI as well. So with the correlation improving back to to where it normally is at high levels, so things are kind of working back with breadth also starting the weekend. We're today at 106, still positive, 100 net new highs, relative to new lows, but we're below the average again. So that's a change. You saw the number of stocks above the 50-day moving average, still below its average there. The number of stocks above the 200-day average dropped back below its average. The ratio of those two, which had dipped below its moving average, has gone back up above it. You can see on this chart, we also, from a Brett standpoint, look at the McClellan oscillator. It's back to negative levels after a positive move last week. It's back down to negative 0.6. So we'll see if we ultimately drop back below that 500 level, which generally lately has suggested the beginning of an intermediate decline. If you're not above 500, then a drop below zero ends up being the beginning of that intermediate decline. So some of these intermediate declines didn't start with that, right? We got below 50, and really it was back over here we dropped below zero. But we are above 500. I do expect that we'll drop below that, and we'll see how soon that is. Again, we have to kind of get below this minus 35 if we're going to get any kind of intermediate decline. Again, this is the time of year for that, right? Going back to the seasonality, if you look at SPX in general, this is the time of year that SPX has a decline down to its lows of the year typically. Kind of like a chart for a day, right? In the day, you either have the lows of the year early in the day, or you have the day or the highs of the day early in the day. In this case, it's like we have the lows of the year early in the year, right? You either have the high or the low early in the year. As you saw in 2021, it was the high of the year, or 2022, excuse me. The high of the year was January 4th, about as early as you can get. But generally, the low of the year is there, and we finish at the high of the year on average. And so we've actually gone considerably higher early this year, and we'll see how that changes. Again, we just finished a 3-cycle. If I were to go to, let's see, it's right here. And let me change this to 3 of these. And then let's come out here to max available, and we'll go out to options expiration. Let's do SPX. So again, you can see we just barely finished this cycle right here of 3 expiration cycles to the upside. We actually had, before that, going into December's expiration, 3 expiration cycles here. Let me show you what those look like on a regular chart here. So let's drop this back down to just 1. So it's actually been 4 now, 4 expiration cycles that we've been to the upside. So let me change that. That's why it wasn't looking correct there. There we go. So here we are, 4 expiration cycles up to the upside here. This is the one that we just barely finished. So this is our new one here, but this is the one that we just barely finished. You can see, this is one of our highest that we've seen in a long, long time, right? Only coming off of the COVID low, only coming off of the 2018 low, and only coming off of a bear market low, were we higher than the 4 that we just barely had, the 4 options expiration cycles. So would not be surprised. Now, these all started some pretty decent runs to the upside. So again, to kind of show you what it looks like on a regular chart, let's go back to 1. So here is that 4 cycle in a row. It's actually 3 out of 4 were to the upside, coming off of the bear market low. There's your 4 in a row there, coming off to 2019. And then here's your move coming off of the bear market low point. So, we never had one big move. It was just the collection of the 4 added together ended up being pretty strong. Again, coming off of a low point, all of these came off of pretty significant lows. So you can look at that big low point, look at that big low point. Then you can see this big, every one of these other 3, this was as big as the low point was, far lower. In fact, we've had bigger ones than this, much bigger ones than this, that didn't produce nearly as big of a rebound as what we've just seen. So in other words, you probably had a little bit more of a move higher off of this low that we had in September to October expiration, then a rebound off of that, then probably what we should have gotten. I mean, again, only 3 others that were bigger. So we're coming into an options expiration cycle. This is what it looks like on this chart. So this would be 1, 2, 3, 4. So coming from this cycle through, we've had three in a row, but this fourth one too, where we've been pretty strong and pretty much closed at the highs of the expiration cycle the entire time. And now we'll see if this ends up being the cycle that ends up being the weakest cycle that we've seen, again, especially considering that we probably had more of a rally, again, if you look at the rate of change, really since when was this? This would be going into last Thursday's peak, would be 75 trading sessions. 75 trading sessions. And we ended up with a 22% gain over that period, as you can see here. That's a pretty decent return. Again, very few moves, and again, all of these other moves were coming off of 7-day returns that were pretty negative. 75-day returns, excuse me, that were pretty negative. So that prompted these rallies. We had a 75-day return that was down 7.5%, which is pretty darn normal. And all of these other moves that were down about that much or a little bit more obviously did not prompt a 75-day rally of 22+%, like we just barely had. So the question will be, and a lot of that, of course, is driven by what we're seeing here in NVIDIA. NVIDIA had a run of 75-day run of 83% higher, so nearly doubling. But again, that's not abnormal for NVIDIA. Usually when we've come off these lows, when you get this move, it kind of starts you on a bullish run. But again, that was coming off of a major decline. This one over here, you continued a little bit higher and then just went flat for a good chunk of time. This eventually worked its way down to zero over 75 days, as it did over here as well. And probably a pretty good chance that this one eventually will work its way to zero quicker, like similar to some of these others, than what we saw this go around, where it stayed up for quite some time. I don't expect that to be the case. I expect that you can see even on a weekly basis, the last 75 weeks, which is obviously more than a year, about almost a year and a half, a 400+% return is far more than what we've seen in the last so many years, and really is only bested by that move in 16 and 17 up to the upside. So needless to say that this is a big driver of the moves, the rallies we've been having. You can see something like NVIDIA, which did also benefit during 16, 17, and especially coming off of COVID, has not been nearly as bullish. Neither has any of these other kind of more bigger names. Microsoft, you can see, is a relatively decent size move. Meta is its biggest move that we've seen in a while. Broadcom, of course, also doing the same thing with the AI move, and then Google and Amazon not having. So it's kind of a new, the old legacy Magnificent 7, portion of the Magnificent 7, not really getting the big boost that the newer members of the Magnificent 7 are getting, that are obviously associated with this AI development. All right, now let's take a look at our trade idea of the day, and we'll take a look in the technology space, and it's Oracle in particular. So we got a bull tag on Friday before, so that means we dipped below the 30-day moving average. But instead of bouncing, we really fell even more. So we're now down more than 2.5% below the 30-day. The intermediate line still dropping, still above this market sentiment, still in bullish territory, but some pretty bearish short-term sentiment here as we've really declined now. And you can see on the on its weekly chart, you were below the 10-week moving average last week. Now we got a bearish candle here with a falling. You're that close to falling below the 200-week already. You're closing below it. You're probably not going to get there this week, but you see how close you are. From a 3 green arrow standpoint, you can see we are below the 30-day moving average. We're also below the 200 and the 50-day moving averages. MACD has gone negative down there. The stochastics is in bearish levels. Even its moving average is in the lower half of the chart. So you can see a pretty distinct bearish pattern breakdown on Oracle. The DMI broke above 30 on the negative indicator, below 20 on the positive. Looking at the RSI and the CCI, you can see both of those levels broke down, below minus 200 on the CCI, below 40, and you can see we're still on the CCI, you're just barely crossing below zero. So we haven't even crossed below. Technically, we're still in bearish levels because we never did cross back above positive 100. We dipped below minus 100 back over here last year, last September, and we've had a couple of bullish runs, but neither one of them got the weekly CCI above the positive 100 level. And here we are already back below zero again and working our way lower. Looking at the Ichimoku cloud, you can see that we are still have a positive rate of change, and you're still above the cloud, though you are below the blue line, and you lost the bullish trend, and you're now would be flirting with getting, and we've done it here with a pink pattern, so we're not to the green yet. So you see how like we haven't been bullish for very long. We didn't get, this is plotted 26 days forward, so we didn't even make it to 26 days, and we're already almost below the cloud. And usually if you're already flirting with the cloud before you get to that 26-day mark, then you tend to break below the cloud, and that would be the expectation here. If you look at the Bollinger Bands and the Keltner channels, you can see you have broken below the lower band just barely by 1.5%, but you broke below where the bandwidth has been pretty low. You are below the point of control. You also broke below the lower Keltner channel, and the bands themselves have come inside of the Keltner channel. And so you would expect that this would be a kind of a squeeze play where you break out and move to the downside. So what we decided to do here on this squeeze play is come down and set up a bear call spread where we sell the mid 20 delta by 2 strikes away. So this sets us up for about let's see here, let's get rid of this trade. So it sets us up for a little bit more than a 2-to-1 reward to risk ratio, lots of wiggle room. So that 20 delta is well inside of 1 standard deviation between now and March expiration. So pretty decent probability and a pretty decent reward for the risk that we're taking on this trade going again for the next 24 days, next 3+ weeks. All right, well, that does it for today. You've heard from me now. I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.